All right, welcome. Today, we're diving deep into one of the most exciting, high-speed strategies out there for day traders. It's called the gap and go. So, let's start with a question you've probably asked yourself. Why is it that some stocks, the second that opening bell rings, just take off like an absolute rocket? You've seen it happen. Well, I'm here to tell you it is not random. There is a method to that madness, and we're going to pull back the curtain on it. The answer to that question is a strategy called gap and go. And really, it's all about learning how to ride that massive wave of momentum right in the first few minutes of the trading day. So we're going to break down what it is, why it even happens, and how traders try to take advantage of it. Let's get into it. Okay, so at its very core, the gap and go is a pure momentum strategy. What traders are doing is they're hunting for stocks that have a big price jump or a gap from where they closed yesterday to where they're opening today. Now, this almost always happens because some big news came out overnight. The key is, the goal isn't to guess which stocks will gap, it's to trade the powerful momentum that follows through after the market is already open. And you have to understand, this isn't just about lines on a chart. This is pure human psychology in action. Just imagine a company reports surprise blowout earnings overnight. Well, all the traders who are betting against the stock are now in a total panic. They're forced to buy back shares to cut their losses. You combine that with all the new buyers rushing in, and you get a full-blown buying frenzy. The same thing happens in reverse with bad news. That emotional reaction, that is the jet fuel for this entire strategy. But, and this is a big but, not every single stock that gaps up is a golden ticket. In fact, most of them aren't. The pros are incredibly picky, and they have a very strict checklist they run through to find only the absolute best setups. So let's take a look at what's on that list. First off, the catalyst, the reason for the gap, has to be something big. Think strong earnings, a huge new contract, FDA approval, something undeniable. Second, you need to see tons of volume in the pre-market. We're talking hundreds of thousands of shares, at least. That tells you the big money is interested. Third, a low float is a huge plus. That just means there's a smaller supply of shares available, so when demand spikes, the price can move way faster. And finally, you want to see the stock gapping up into clear skies on the chart, where there aren't a bunch of old sellers waiting to dump their shares and kill the momentum. And here's a really simple but powerful filter a lot of traders use. To cut through all the noise, they often won't even look at a stock unless it has gapped up at least 4%. It's a quick way to make sure you're only focusing on stocks that are making a truly meaningful move with real conviction behind them. So, if you take one thing away from this, let it be this. Success with the gap and go strategy is pretty much decided before the market even opens. That first half hour is pure chaos. Trying to make decisions on the fly in that environment is, well, it's a recipe for disaster. So the pre-market routine becomes absolutely critical. It's a simple 3-step process. First, you scan. You use software to find the stocks that are gapping up and have that heavy volume. Second, you do your homework. You dig into the news. Is this catalyst legit? Is it strong enough to keep pushing the stock higher? And third, and this is the most important part, you make a plan. You define your exact entry point, your profit targets, and your stop loss before that bell ever rings. Okay, the plan is set. Now for the hard part, execution. We're talking about navigating the single most volatile and frankly dangerous part of the trading day. This is where discipline isn't just important, it's everything. The classic go signal traders are waiting for is a clean breakout. They'll draw a line at the highest price the stock hit in the pre-market. If the stock can push above that level right when the market opens and do it on a huge surge of volume, that's the green light. That's the market confirming that the buyers are for real and they are in control. And recognizing the difference between a good entry and a bad one is, well, it's the whole ballgame. On the left, you've got that textbook entry, a clean breakout on massive volume, and the price holds strong. But on the right, you see the traps that get so many people. Chasing a stock that's already way up, jumping in on weak volume, or buying into a fake out that just immediately slams back down. Knowing this difference is what separates the pros from the gamblers. And this quote just says it all, doesn't it? That fear of missing out, FOMO, is the single biggest enemy for a trader using this strategy. A disciplined trader would much, much rather watch a stock rocket higher without them than break their own rules and jump into a trade that doesn't meet their strict criteria. Your number one job is always to protect your capital. And that brings us to the ironclad rules. These are non-negotiable. First, you have to know your stop loss, your I'm wrong point, before you click the buy button. Second, your position size is based on how much money you're willing to risk, not on how much you're hoping to make. And third, as we just said, you simply cannot chase stocks, ever. It's also really important to understand that this is not an all-weather strategy. It doesn't work every day. It truly shines in very specific market conditions and can totally fall flat in others. So, when is it hunting season? Well, the perfect environment is a market that's buzzing with news and has high volatility. Earnings season, for example, is like the Super Bowl for gap and go traders because you have this constant stream of powerful news events. It also works great when a whole sector is hot or when you have a lot of retail traders jumping on board. Remember, momentum needs a crowd to keep going. On the flip side, think about those quiet, sleepy summer trading days when nothing's really happening. This strategy gets really tough then. You'll still see stocks gap up, but they just fizzle out. There's no follow-through, no conviction. A smart trader knows that sometimes the best trade is no trade at all. They know when to just sit on their hands and wait for the weather to change. So there you have it. That is the complete blueprint for the gap and go strategy, from spotting the setup to managing the trade. The mechanics themselves, they're pretty straightforward, but it all comes down to one final really important question. Knowing the playbook is one thing, but having the discipline to execute it perfectly in the heat of the moment, when the pressure is on, that's what really matters.